Okay, now I'm going to share. Boom, boom. Okay. All right. So, all right. So what I got the daily chart up here, right, guys? And in fact, let me just see on the daily chart. I don't know if any of you guys. So right now we're just kind of ranging sideways. It's a large range, but where we are ranging. But you know, one thing I want to point out here is, you guys familiar with the term zone flip? You familiar with that?
Thanks, I am.
Okay, so a zone flip is where we have like previous resistance. I'm sorry, previous support becomes resistance and vice versa. So if we were to do this right here, right, and then put another block here, that's the zone flip. In fact, let me do this. It'll be better that way. So you have support resistance. We have it ranged. Majority of the ranging was done on the upper band here. The if we were to define where, so let me drop the fibs. Fib retracement. Okay. If we were to drop our major structure for fibs, this is where it would be, right? It's actually now there because that's the bottom right there. So that's where it would be. Basically, price came down on the 19th, dropped here, came up. So this is major swing structure. Everything else in here is, this is the major structure. This from this point right here to this point. And that is what, 42 to 28, approximately 10,000 pip range. Most of the ranging that we did since May going into, what is this, June, for a period of 4 weeks was this upper band. Then it dropped down into this lower band. And if you notice, we're consolidating in this lower band. This is what's called a zone flip. This previous support now became resistance, and this became support. Does that make sense? That's why it's called a zone flip. Basically, we flipped the zones from upper band to a lower band. And in reality, it's what's called, we dropped levels. That's what we did. We dropped to a new level. This is where the level was here, dropped down, came into a new level. I actually explained this about 3 weeks ago on a Saturday with Will and Matt. I don't know if any of you guys were on in that. When we hit down here, I told them that I don't think we're going to drop below yet. That there's a likelihood that we will range sideways, and that sideways range will be approximately 4 to 6 weeks, because this is what it does. It operates in 4 to 6 week cycles up here. See that? So we should expect the same thing here, 4 to 6 week cycle, and we've seen it drop down to this level here. Now we did a zone flip, and now we're ranging sideways again, 4 to 6 weeks here in the sideways. So where are we going to go from here? Okay, here's what I see. I see right now that some of you guys might have even caught this, right? Right there. Oh, and what is that?
SMS.
Yeah, that's an SMS, right? Let me make it thicker. Could we, and okay, so if this is SMS, we would need BMS. What's nice about this SMS is this line here, this point, is created an area where we would see a break in market structure, this high here at 36. We would need price to break that in order to have a confirmation that the SMS is valid for a change in trend. We would need to see that. Does that make sense?
Yeah,
Mhm.
definitely.
Yeah, that's what we need to see. So, you know, where price is going to go, I don't know. You know, I can only tell you where the what would happen, where we would see a change in trend, and I can only tell you where order blocks and price imbalances are. But if price breaks here above this, this makes this SMS valid, this BMS, if it breaks this. And then that being the case. Now, here's the thing. If price breaks up into above this, breaks this for a BMS, no need to get panicky that you might miss it. Price could actually come all the way up to here. Wait for the pullback. You'd actually wait for the pullback to go back into this band again, because that's what price does all the time. So what I mean by that is what Justin had asked, hey, can you show me the price mitigation? Yeah, that's exactly what it is. So here's how it works. Let me show you. In fact, I was going to show you this the last time on the last call. Do you remember? And then you guys had to get off. I was going to show you this price mitigation. Okay. So what happens is price goes up, right? Whoop, wrong one. Get that polygon. Okay, so let me make this smaller. And then let's, whoop, that looks weird. Oh, okay. Polygon. Okay, so I'm going to do it. This is for a sell, and I'm going to do it for price mitigation for
buy.
Yeah. Okay. I don't know if I could stretch that. Oh yeah, there we go. Much better. Okay. So this is what you would normally see price, and this is on the top. Let me show you. In fact, I could show you it on here. This would be a good example. I'll drop it to the 4 hour. It'll be even clearer. So what happens is price is climbing. You know, you've got higher highs, higher low, higher high, and then BMS, right? Price drops down. When price drops down, it always comes up to mitigate this order block. This is an order block. Although we're looking for the order block in this range here, within this this pull down. The reality is that the price, when you see a reversal like this, right, you'll see price mitigate back to this order block. That's typically what you'll see. You could now, what would create more confluence is if you had an order block or a price imbalance inside here, and then it met up with this order block here. You will see it will bounce back into here. So if you read this, right, what you've got is this point right here as a BMS. All right. So when price BMS is, no need to panic on whether or not you're going to get in late, because you might decide to get in and it's right here, but price pulls back. And remember, we're dealing with Bitcoin. Those pullbacks are big numbers. You know, this could be 3,000 points, this pullback. And if it does, ideally just wait for the pullback. Price will always come back to pull back. There's a situation where it doesn't pull back right away, right? In fact, let me do this. Hold on a moment. Wonder if I could Okay, one more. Okay, so you've got here SMS, all right? When you have an SMS that is clear to read, and then you have a BMS that follows, you can expect price to mitigate back to this point, okay? This is the natural flow that you would normally see. However, I want to move this. Shoot. If we see price, well, huh? It's not. Maybe I grab it. There it is in the middle. Okay. Ignore this one for a moment, okay, guys? Because this will make sense to you guys. You'll see it. You'll go, okay, I see it. Just give me a second. Boom. Okay. So if you notice this here, this is what you would see as what's called a type 1 mitigation. Type 1 mitigation, you'll see SMS followed by a BMS. When you see an SMS followed by a BMS, price will bounce back to the order block, which is this here. This order block right here is where you'll typically see it bounce back to. And I'll show you examples on the chart in a moment, okay? However, if you see BMS on a straightaway and there's no clear SMS, because look how deep this SMS would be, you should see price range sideways and he's not coming back up here. Does that make sense? So how do you know whether or not when price does a BMS, whether or not he's going to come up to mitigate? How do you know? Because it all depends on whether it's a straightaway, straight into a BMS that breaks the structure, or if you have an SMS and then a BMS. Because if you have SMS and then a break in market structure, he'll come back to mitigate. If you have straight BMS, he is not going to come back to mitigate. He will range sideways here for a while and then maybe come back up here, but he's not coming back here anytime soon. It might, when I say anytime soon, it might be like by tomorrow or the next session, the next, he might have did this in Asia, but might come back later to hit this later in New York, but he's not coming back to it anytime soon. Whereas if you see a BMS here, you could expect within the next hour, 2 hours for price to actually come back here. If you're looking at the 1 hour chart, you can expect it to come back up here, test this on the pullback, and then continue down to its bias direction. Does that make sense?
Yeah. Hey, real quick question, Joyce. So yesterday when we were talking, you were kind of giving a theory about it as to why, and I,
Yeah.
is there any way to kind of just quickly,
Yep.
briefly elaborate on that?
The theory behind it,
Yeah.
the reason why behind it is because imagine you've got a lot of activity going on in here. You have buys and you have sells. The market maker's privy to it. We are not privy to it. Hedge fund managers are not privy to it. Whales are not privy to it. So I'm going to give you one perspective. All right, and because this can be confusing if you try to wrap your head around with too many point of views. So we're going to keep it real simple. And the simplicity of that point of view is going to be you are a hedge fund manager. As a hedge fund manager, okay, you are going to look to put an order in to move the market in a particular direction. So you're going to drop 50 million to push price down, and it's a heavy push to the downside. Remember, when you push this down, the circus effect is going to kick in. Others will actually start jumping in. That's why the movement is so big, so swift. It's a very violent move to the downside, with the amount of money that initially started the inertia balling, and then everyone else jumping in because it just continued to move and breaking structure. It didn't have its natural ebb and flow, higher highs, higher lows, higher high, higher low. It literally went from higher high, boom, to a lower low. All right, so that's why we have BMS, no clear SMS. The theory behind this, what's
Oh,
going on?
yeah.
Yes, the theory behind this is that there was a lot of money that moved this to the downside because they wanted to change the direction very quickly. All right, and when that BMS happened, they're not coming back anytime soon. There was a collective agreement because you got to remember, hedge fund managers, although they've got a lot of money they're wielding, and institutions, they operate just like you and I. Imagine if I had 100 million, you had 100 million, Justin, and Mike, you had 100 million, John, you had 100 million. You know, the five of us are going to be calling each other saying, "Hey guys, I'm about to drop 50 million. Come in with me." You see what I'm getting at? And that reality only came to my awareness when I watched Soros talked about it in an interview. It was a very old interview. He had said, "My friends and I can move markets." And I was like,
Mm.
wow, that was something that stuck in my head. At the time, I didn't make any, I wasn't trading at that time, but that was something that stuck in my mind that they collectively do it as a group, you know? So they do it as a group, retail jumps behind it, and of course, the ball is rolling. So the theory behind it is that so much money was pushed down that it wasn't a mitigation of 20 million, right? And then a reversal for another 20 million to come back and mitigate it. It literally was a BMS, a lot of money, friends in cahoots, push it down, and they're not coming back up here anytime soon. Does that make sense?
Yeah, makes total
Okay.
sense.
So this here on this, when you have SMS, think about again what's happening. Also, another thing you have to understand is that there's stop losses up here, and that's where the market maker is going to look to grab that liquidity. So he's going to look to grab at that liquidity, then push the market down. So there's a lot of activity going on, but I needed to keep it simple so you guys get it and understand what theoretically what's happening, and why price does not come back up into this area. You know, you would expect it to, but he might come back later, like at the end of the week or next week. You know, does that make sense? On this here, on this particular mitigation, this particular push. So here, imagine again, you're looking to push the market in a particular direction, you know, but you're still playing higher high, higher low, higher high, higher low, uh, lower high, SMS, and then you have your BMS. So this fail to make a higher high, and that failure was actually, say, a $50 million move, right? And because perhaps you have group A, five friends that are all together in cahoots, they move the market in a particular direction, right? Group B, they're negative, and they're going to push the market to the upside to basically mitigate. They want their position that was that they got in perhaps here, right? 50 million is now
Mitigate their losses.
40 million negative. So they're going to drop another 20 million to push the market up, only to get and break even, but even to profit from here to here. Does that make sense?
Makes
Oh,
perfect sense.
all right, guys. That's what's happening behind the scenes. And theoretically, that's what's happening. There's a lot more activity going on, guys, than what I just explained. But you need to wrap your mind around what's happening behind the scenes, so that and we simplify it by just kind of what would the money manager do if you had $100 million? Okay.
Hey, can I ask you a real quick question, Julius?
Yeah, sure.
Okay, so I'm be doing some other research or reading about like market makers in general,
Yep. Yep.
and so one book I'm reading, they're basically talking about market maker strategies, and what they were saying is during the accumulation phase,
Mm-hmm.
what the market maker is actually doing is he's actually accumulating contract data,
That's right.
how many longs, how many shorts, and so essentially, if you logically say there's 300 million longs
That's right.
and 100 million shorts.
Mm-hmm.
you best believe he's going to, go after the larger liquidity, which is the longs.
Hmm.
Um,
Yeah.
and so their strategy is basically utilizing that and doing the stop hunts and everything like that to grab for those and trick and redistribute liquidity. Is that I mean, what I'm asking is that in alignment with what you learned
It
or
is. Yeah. The market operates with accumulation, manipulation,
distribution?
distribution. Yeah. So, and what it would look like is this: accumulation. Oh shoot. Me. Yeah, that's and Wyckoff does not talk about the manipulation aspect. So this is accumulation, right, guys? This could be the manipulation, this move to the downside, and then he accumulates again. And then, of course, that would be the distribution. But that's what what's going on with that
The market maker?
yeah, with the market maker and accumulation. Accumulation is an opportunity for him to accumulate contracts. He wants to read the market. He wants to see what's going on as far as which way he's going to be taking it. He ultimately he has his marching orders to get better pricing for um,
For dealers,
yeah,
basically.
for basically for the
That's the book
dealers.
I read for the dealers. Yeah, the market makers work for
Yeah,
the dealers, and
that's
okay.
right. Yeah. Are you reading Steve Morrow's Market Maker Method? Is that what it
I'm
is?
reading like review books. Yeah, I'm
Yeah.
reading. I found this old day trading book that talks about market
Yeah.
makers. That's
Yeah.
the thing I'm not.
Yeah.
But that's a big thing I want to say is that
Yeah.
like I the reason why a lot of these people are getting beat down on the indicators, the regular indicators, is because the regular indicators are basically based upon what mass psychology,
Yeah, it
right?
is. Yeah.
From the
Yeah.
side,
Yep. That's
where
right.
this is just completely a different animal.
Yeah.
More money.
Yep. If you know why the market maker is moving price in a particular direction and you understand institutional flow, order flow, it's all you need to know as far as how to read the charts. Then you just need to know market structure, which is higher lows, switch in market structure, break in market structure, how to read overall market structure. And then once you know how to read overall market structure, you know how to read chart patterns. Patterns we're going to be looking for are the M pattern, right? Like this, right? The M patterns. We're going to be looking for the W patterns, like that, right? And then, of course, there's head and shoulder patterns, and then learning how to read candlesticks. That's it. Those three things. How you wrap it together is how to read it from high time frame to low time frame, so you could find entries in order to enter into the market. And that's it. The craziest part is actually this is a pretty easy formula. I'm reading market structure, chart pattern, candlesticks, and I'm learning to read it from high time frame to low time frame so I could find an entry based on institutional order flow. It's such an easy formula, right? All the extra noise that everyone pours on their screens is not necessary. Not necessary for us to learn how to make money, not even necessary for us to understand how to read the market chart so we could determine whether Bitcoin is reversing or not. All that other stuff is just noisy and it's a lot of BS. But the reality is that that's all you really need to know how to read the market, which is you want to know when change occurs. You will read change through switching market structure, breaking market structure, understanding right now we're accumulating on this lower band. If we break up to the upside, we're BMS, and we should expect now price to be ranging towards the upside, because then we have SMS, BMS, and a confirmed change in trend on a daily chart. So overall, if you take a look at what we're doing, is we are reading institutional order flow and having a good understanding of what the market maker is doing. That's all we're doing. Make sense? Right? Any questions so far? Hi, guys.
Oh, it's wonderful. I mean,
Okay.
you already know with me, I'm just the high time frame to low time frame was the
Yeah.
was the thing that still need a little bit of work on. But
Oh
yeah,
yeah,
thank you.
yeah. Yep, you bet, you bet. Give me a second, guys. I'm gonna just look at something really quick here. Let me go to H1. Okay. Hold on. So I'm still in last night's trade. I've got a stop loss, but okay. So on this one right here, this is to the downside. Okay. So we've got here. This is a BMS. Actually, you know what? I should have. All right. You know what? I'll just leave it like this. Okay. So if you notice here, right? You know what? Let me do it right. Let me just do this right so you guys really get it. Okay.
Looks like a reverse heading shoulder pattern.
Yeah, yeah. I just get a little sloppy with my. Okay. So let me just label this so you guys can get a clearer picture here. So we have SMS here, right? And then I'll drop the line for the SMS so you can visually see it. All right. All right, and then you got a BMS right here, that BMS. Okay. So we have lower lows, all right? So it went lower low, lower high, lower low, equal highs, came down, SMS, came up, BMS, mitigation right here. So if you notice what happening, he mitigated back to this area of liquidity. Although you might see a little, once he BMS, you might see a little stutter step pullback here, right? But you can expect price to come back to mitigate to this point right here. All right. This is the opposite of this one right here. That's what we've got going. So if we were to look at the, let me just do this so you guys. All right, there we go. So the opposite way is if we were coming down, right? Boom, boom, boom. BMS. Okay. We've got BMS here. No SMS. So we've got from the bearish to a bull trend, we have SMS, breaking market structure. Once it breaks structure, it comes down to mitigate. Came down to mitigate. And you have to trust that this mitigation will happen. So as long as you have SMS, you can expect BMS to occur. The reason why I say that is because in the past, I actually used to jump into the trade, get in here with gold or some other pair, and then price pulled back. And when you learn to trust, the pullback is going to happen because it's just the natural flow of how institutional money is going to be moving the market, right? Also, you got to remember that the market maker knows that people, once they BMS, a lot of people drop their stops right here. So the market maker, he will come down and grab at this liquidity. So you know, there's a lot of stuff going on. aside from the opportunity for institutional or a whale to mitigate pricing in order to get better pricing or to improve on a failing, a losing trade. There's also the stop hunt. So when price BMSs after an SMS, expect price to come back to hit this liquidity area. This is actually my trade, Justin. Last night I got into that
Yeah.
trade. This is how I got in. I actually got in because of this right here. Boom, boom, entry, came down. This one, right?
I
And I,
saw that. Yeah,
yeah,
and it's funny. I saw it last night too, and but by the time I was already running some errands, and I already it was too late for me to get. I was like, gosh, but a
yeah,
good job by.
yeah. So, and I closed out with $1,000, close to 1,000. If you remember, I got into that trade. I had a small profit, and then it produced an M pattern. In fact, I'll show you guys. I'll show you so we can go through it. Any questions on this here? Just know that if price BMSs and you don't see a clear SMS and you see this here consolidation, do not expect it to come back to the BMS to mitigate. He's pretty much taken off because they move so quickly that they are not coming back to that point anytime soon. When I say anytime soon, if you're looking at the 1 hour chart, he might come back to it later in the next session, but he's not coming back to it in this current session. All right. He might come back to it next week. All right. But just know that when you BMS, we should not expect price to come back anytime soon. Okay. So go ahead.
So it varies from time frame.
Yeah, I look at so many hourly charts that if I see this produced on the hourly chart, I know that because let me go back to what my point of view is and my perspective. I am a trend trader, right? And as a trend trader, I love waiting for pullbacks. I love this. This is what I love. I like it when it BMSs and I wait for the pullback and then I get in and ride it. I like it when it BMSs and I wait for the pullback and ride it. But I know that if we BMS and we sideways range, there's a high expectation that he's not coming back to this line again, to that BMS line.
Okay.
All right. So from the perspective of how, okay, I see this all the time on the 1 hour chart, all the time. Remember, charts are fractal. So I'll bet you if I studied up on the daily chart, it'll do the same thing, do the exact same thing. All right. So any questions on this? On the model aspect of what's going on? Yep.
Yeah, I don't have a question, but I just have a comment. I mean, you point out a bunch of times too, like when Bitcoin started, you had an official BMS.
Yeah.
That SMS on the daily was very, very small.
Yeah, yeah.
Remember, it was a very, very small SMS. So
it was, but on a daily time frame, that was significant. And yeah, that was it is a very small one right here, but nonetheless it was still significant,
Yeah.
So since we knew, yeah, we knew that price was going to come up and take a look. Now watch this. Here, this is exactly the model, right? Oh, oh shoot. All right. Price came back to mitigate, but he hit an order block actually. He hit an order block. Yeah. But they came back. There's a price imbalance inside here and an order block. But you know what? Even this right here, this order block right there. This is the top of the order block. This is the bottom of the order block. Price is inside this range. And yeah, this is where an exit could be called out. All right. So if you notice here, right, you know, it almost looks like the model, but theoretically it did exactly what it was supposed to do, which is we BMS right here, right? SMS to a BMS. It's a very, very tight SMS here. But because it's on an hour, a daily time frame, it's significant. I mean, it's a big deal. That's the SMS right there. I mean, it's a very steep, shallow one, but you know, it is what it is. In fact, let me just all right. That's the SMS. Now watch this. So he SMS BMS like immediately after, right?
Yeah.
You see that, guys? You know, price came back to mitigate inside, grabbed at that order block. You got that, John, Mike?
Yes.
All right, cool.
Yeah.
So why did this even happen? Think about it. Reason it out. You've got your hedge fund manager. You originally placed a order here, 50 million, right there, went up, and now you're 70 million in, right? But someone put a large order here, and that large order was, like collectively, push the market down for an SMS, push the market deeper for a BMS. This 50 million is negative, probably down to 30 million. He drops another 40 million to mitigate. And that's what we have here. A mitigation to heal a losing trade, to mitigate, to improve upon a loss. So price was here. Collectively, whale institutions, because you know they're not privy to market maker data. They don't know how many buys, how many sells, who's got stop losses. They don't know that. You got to understand that the whales institutions play the same game that we play. The difference is they operate collectively as a group, like a bunch of fucking lions. You know what I mean? And they're the leader of the safari, and they walk around strutting because they got the cash. But for the most part, when they bleed, we bleed. When we bleed, they bleed too. So they have to mitigate. Because if you had the money to move the market to mitigate and improve a losing trade, you would do it. You know, and they've got it, so they do it. So when that 50 million is probably now 55 million, they exit because they know that this was a real SMS that occurred, and powers that be are pushing the market down. The market makers taking marching orders from powers that be to push the market so that whales and institutions will be able to get better pricing. You know, for whatever reason, it's just how the market works. This is the manipulation that they play, and we ride coattail in order to make money. That's it. You know. So that is an example of what we have, of what I just showed you. Okay. So now, what I want to do is kind of show you how to read levels, because I might just give this to Stephanie as we're recording it, and I know she has an interest in reading levels. So we're going to do that. Okay. Any questions on any of this before we move on? Because I'm about to clear all this out. Are we good? All right, we're good. Let me see. Hide drawings. Boom. Nice. Okay. So we got a daily chart. We're going to drop it down to the 1 hour chart. All right. And on the 1 hour chart, we're going to do this. So usually when I'm trying to mark up for levels, so what do I mean by levels? I mentioned this to you guys before. I don't know if any guys, what happens is the market, oh shoot, well, how did that come up? Oh, you know what? I think these were remove. Okay. All right, there we go. What
Are levels
happens
and
is,
ranges,
go ahead, Justin.
are levels and ranges kind of the same, or
No,
actually
no,
no?
then ranges. So when I say the word ranging, it's like this chart is ranging. Ranging is a terminology for sideways accumulation. You know, that's what it is. On a daily chart, right? On a daily chart, price is ranging sideways right here. Drop the level, ranging sideways here. Does that make sense?
Oh yeah, no. I was actually talking about something different. I was reading in regards to London, New York, and Asia timeframes. But it's okay. It's nothing. I don't want to mix anything together. Sorry, we just keep going. Sorry about that.
Okay, that's all right. Okay, so what I mean by ranging is price will, you know what, let me remove some of these other rectangles here. Price moves like this, you know. Excuse the fact that I'm like inside of all this stuff, right? But that's downward. Next thing you know, pushes down one more time, boom, right? And then reverses the market, pushes up, right? Pushes up again, and then pushes up one more time. Okay, so that's what I mean by levels. These levels are what traders will mark off as level one, right? This is a theoretical model about how the market maker operates. This is level two. If you notice, it kind of looks like Elliott wave, right? You guys seen that? You know, I know some guys like to use that terminology. Level three, and then here would be peak formation low. Okay, and then again we're back to, since that's the low, we got new level one to the upside, new level two to the upside, and then new level three to the upside. Then the chart will break up to the upside one more time, right? And then you now have a peak formation high. And now that you're at peak formation high, you're going to see the market start to drop down. Right? And from, you now have new level one, new level two. You see what's happening here, guys? You see this? Huh?
Yes.
Okay. So that's what it looks like. Let me just see something, if I could remove some of symbols. Body, water, wick. Okay, yeah, there we go. That looks much cleaner. We'll bring this back later. But that's it. So price would look like this. This is polyline. So what happens is you have like boom, 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 breaks down, peak low, up, breakout, up, break out to the downside. You see that? That's what the theoretical model. The idea behind it is that the market maker is moving in threes. And 3 is a significant psychological number. Now, does he always do 3s? No, doesn't always do 3s, right? Sometimes you'll see 4, sometimes you'll see 5. But that's how you read the levels. And when you're reading levels, sometimes he just does level 1, level 2, and then he goes into an accumulation period, and that's called a reset, right? But as long as you could identify peak formation high, peak formation low, which is major structure. Can you guys see that? Can you understand? You will know where you are within the levels. Why is it important to know how to read levels? Because if there's a theoretical model in which the market maker is operating off of 3 levels, and you can identify a major structure, a peak formation low, once he breaks to the upside, pulls back, here's my entry, breaks to the upside, pulls back, here's my entry, pulls to the upside, pulls back, here's my entry, pulls to the upside. So if you notice, I made 3 entries. Does that make sense? So if you know where you are within levels, you could pretty much get a general idea as to whether or not there is a continuation to that bias direction. Does that make sense?
Yeah.
Okay. So I'm going to erase all this, right? And then I'm going to actually show you on the chart. And let's see, how do I erase all of this at once? Hide. I don't want to hide. I want to erase all of it. Stay in drawing mode. You guys know how to do that? Erase all, remove. I want to
Remove
remove.
the stuff we did earlier.
I want to
I think you
remove.
just- Yeah,
I
it says
think.
remove drawing.
Oh, okay.
Right.
Here,
Right?
Right
here.
click and remove drawings.
Yeah, here it is, right here. Okay. Oh, this is a faster way right here. See this? Okay, there we go. Okay. In fact, right here. So if you notice, guys, I went to the object tree. Let's just remove that fib and this. Let's bring back our candlesticks. I need body, border, wick, boom. Okay. So when you're reading levels, sometimes the best ways to read levels is actually on a 1 hour or on a 4 hour chart. Some people can read levels on a daily, but I don't know. That I read them on the 1 hour and 4 hour. Let me explain something about levels. You could talk to 10 different people and you'll get 10 different ways on how to read a level. In fact, how my understanding of levels is that it's something that people will take up to a year to learn how to read levels because you need enough chart time to actually start to see it, where you say, okay, I could see where we are. I see peak formation high. I see peak formation low. Now, based on peak formation high and low, I could see that we've got 3 more pushes to go. So I could see if I did a swing trade, I could hold this for the rest of the week. You see, but understand this, that when it comes to learning levels, it's not as important as knowing how to read market structure, how to read chart pattern, and how to read price action. Those are the most important things. However, to know how to read the levels is really important because then you could decide how long a trade is going to perform, how long a particular direction is going to perform. Does that make sense?
Yes.
All right. How I've learned to simplify reading levels, because a lot of people take a year or even longer, but for some reason, my brain wrapped around it fairly quickly. And how I learned to read levels is as long as I was able to identify where the peak formation was, right? I knew where the levels were going to be. However, when I had learned to read market structure properly and I identified major swing structure, and eliminate the noise of all this middle minor swing structures, then it helped me to refine my ability to read levels even better. Okay. I'm going to do one more thing before we get started. I'm going to throw in some indicators here, which is going to be the moving average. Okay, 1, 2, 3. Okay. Another thing when it comes to reading levels is an easy way to read levels is through moving averages. And there's another way to read levels really easily as well. Hold on, let me change some of this. Okay, so I like the yellow at 20. All right, and then I like the 50 to be this baby blue. I like it lighter. Okay, and then 200 EMA. I like it at on just white. Okay, so we're on a 1 hour chart right now. Okay, and first thing we're going to do is I'm going to go to the 4 hour. I'm going to identify my peak formation highs and lows. Okay, right here, peak high, peak low. Okay, peak, which of course is major swing structure. You guys get that, right? Yep, major swing structure, peak formation, low, boom. Okay, so we have peak formation high and low. And again, take a look. What's the significance of this? Because of this, we get a place to drop our fibs. We know, because what does dropping our fibs do? Dropping our fibs tells us where institutional discount range is, so we can find good entries for buys and sells, because price is ranging right now. So take a look. Like right here, once price broke above the 50 here, I knew I was looking for a sell, and I was waiting on the 1 hour chart for candlestick patterns or chart patterns to show me reversals on a lower time frame. Okay, so right there, that's one fib. Now, what happened was when price came here up, in fact, let me do this. Price came here, came up, came down, came up again, came down. Now, I knew, because this here on a 1 hour chart, that this is my peak high on the 1 hour chart. All right, so I do this. And that's significant as well. Remember, when I'm looking at determining institutional discount range, I am dropping the 50 line. So I can, now that I know the 50 line on this peak formation high, peak formation low, I will actually remove the fib, because I got that. And that is, I know that's the hard 50 for this large range. Now I have a new range on the 1 hour chart, which is this right here, from here to here. So since that's my new range for peak formation high, peak formation low, I also have another fib line that I need to drop, which is going to be from here. And we're going to extend it all the way here, right? Because we have the 1 hour fib, institutional discount range, and we have the 4 hour fib, institutional discount range. And that 4 hour is a big deal because it's way up there at the top, way up there. You know, that's the big one. All right. But even this is significant as well. But so on this one right here, I dropped my fibs. I have institutional discount range. I know where the 50 line is. What I like to do is I like to mark that 50 line. And what I'm going to do is I will change that to a right here. And I want to do a dotted or dash line. Okay, and then just to clean it up so it looks really clean and don't have a lot of bullshit going on the screen like everybody else does, clean it up. So I have my 50 lines because that's really all I'm concerned about, right, guys? Okay. So how did I even know to get in onto this here on last night's entry? How did I know? How did I know this? Because we broke the 50 line on the 1 hour chart. We are now in institutional discount range. Ideally, I would want price to hit the 50 on this or better, like back here, like here, like here, but it didn't give me it. Gave us, broke this 50, the 1 hour, and it gave me an entry here. All right. All right. So since it gave me that entry right there, right? Give me a second here. Oh. All right. So on last night's trade on the 1 hour, right? Here's what I was looking at. I knew that we had a lot of liquidity here, a lot of liquidity here. These were previous highs. There was a high potential that we would go up to that, but there was also a chance that we would not. And what I was reading is on the 1 hour chart, I know because institutional order flow is still for a bearish trend. You know, we're still moving down on the daily chart, right? Especially the fact that we did a zone flip from up here to down here. So, and looking for the entry that I found last night, I know I'm going off on a tangent, but we're here. So before I get back to the levels, I'm going to show you what I was looking at here for my entry. Okay, so on my entry, equal highs here. I was expecting price to go up to here. It did not. So since price did not go up to there, I waited for the 1 hour chart to give me a stop hunt, which it did right here. It gave me a stop hunt right here. Gave us a stop hunt here, actually. Gave another stop hunt, which was much more evident here with railroad tracks. Okay, let me blow this up. That railroad track with the stop hunt was significant. Once it came into here and gave another stop hunt with an engulfing, this candle totally engulfs this doji candle, I knew that was the entry. In fact, it gave one more stop hunt right here. So it gave 1, 2, 3 stop hunts. Typically, you would normally see 2, right? That's what, and the expectation is 2. And but you know what? Market maker's greedy. Grab that stop loss for a third time, and then he brought price down. It's just the way it is. What I often say is that when the market maker comes back for a third hit to grab its stop losses, out of sheer greed, you own them. You got them. Make sense?
Mhm.
Yeah, I saw that last night, man.
Yeah. Yeah, that was the entry. In fact, okay, so just to go back to this, Justin, you last night when I was with you, we got in here, right?
Yeah.
Oh no, actually we got in here. That's right.
Oh,
We got in right
yeah,
here
we're in
first.
from buy,
Pull
yeah.
pullback, yes. We got in on this pullback. So we got in on the pullback. Price went up, and then oh no, it was the next day. Okay, here it is. This is it. We got in on this pullback. We were talking about this doji. You remember?
Like, yeah, the first leg, and then yeah, because then
Yeah,
you were talking about that
the
that
sell.
type on the
Yes, type 1
sell.
mitigation. Yes. Okay, yes, this is it. So we actually got in here. Price went up. I was in profit, and price was starting to pull back. When it pulled back, and I seen the stop hunt, I said, they're not coming back to these equal highs. That stop hunt was starting to form this candle. Once this candle was formed, I said, okay, on the 30-minute, I said, you know what? I'm going to close this because this stop hunt was an indication of a reversal. So I closed this with a very small profit, got back in for a sell. When I got in for a sell, I was in profit here. Price came back up. Now I'm negative. I had a very tight stop loss, so it automatically kicked me out. Once I got kicked out of this stop loss here, I seen this engulfing candle, right? And I said, gotcha, because that was 3 hits to the high, and I got in.
Yeah.
Yeah, that's actually what happened. So really, he was coming up to test for equal highs, never came up to hit it. But since I knew that institutional order flow is still for a bearish, that any attempt for me to get in on a bullish play was a very short term. In this case, it was so short term that I made a small profit, wrote it for a sell, exited out, and I had a small loss because my profit had mitigated my small loss. But once he came up and formed this engulfing, I knew, boom, I'm in. That was my entry because that was 3 hits to the high, a multi-leg M pattern. That's actually what it's called, Justin. This chart pattern is called a multi-leg M pattern because you expect it to be just this, right? But no, market maker's greedy, so he came back up for one more hit. And so that's a multi-leg M pattern. That's really what it is. So take a look at what we have. We have market structure telling me overall, right, that we are on a bearish trend with SMS, right here. So understand my thinking, guys. I'm thinking from market structure, price action, candlestick. So on the high time frame, that's SMS. I know that institutional order flow on the daily chart is still bearish. Still bearish. It is what it is. So on the 4-hour, I know that we have SMS, and because we never came up to break this SMS, right? We never came up to break this. Yep, right there. That this anything produced underneath is still going to be for a sell. So now I'm looking for a chart pattern on at any particular market open, Asia or London market open. I'm looking for performance on a chart pattern and a candle pattern. So I drop to the lower time frame, right? Coming out of Asia, this dotted line right here, these dotted lines are switch in market between yesterday and today. So yesterday, when the market switched, Asia gave us a little bit of consolidation, gave a chart pattern of a multi-leg M, came back up to test, never came up to hit equal lows. However, keep in mind that even if we did not hit equal lows, right, that the liquidity of this range, price still came up to tap at it. Do you see that? That's why I knew that this was valid for a sell. Because look,
That's,
makes sense? So,
yeah. Hey,
yep, high time. Yep, go ahead.
Let me interrupt. Hey, I'm gonna hop off. I'm so sorry. I gotta go put my kids to bed. But man, I just want to say thank you so much. I'm looking forward to seeing the rest of the recording, man.
Yeah, you bet, you bet. I'm just gonna wrap it up, and then I'm gonna cover levels, and then we're gonna call it a night. So again, high time frame daily tells me institutional order flow still for a bearish trend. On the 4-hour chart, we have SMS, never broke the SMS line, which is this dotted line up here. Never came up to break it, came up to test it, but never came up to break it. So that basically still concurs, confluence that we're still moving down on a bearish trend. So when market opened on that particular time frame, I was looking for entries for sells. Automatically, my brain's already looking for it. So since I'm looking for entries for sells, I'm dropping it to the 1 hour, and I'm looking for a chart pattern. Chart pattern being an M pattern, head and shoulders, anything that's going to give me a reversal pattern to enter in for a sell. I drop it, and then once I see first leg of the M pattern, which is this, that was first leg, right? With a stop hunt, I immediately said, okay, if he gives me a second leg, I'm in. And he gave me a second leg, which was this right here. Engulfing, that right there, and even on a lower time frame, right? He still came up, and take a look, doji with engulfing. In fact, this candle right here created what's called a 3-bar swing. These two candles completely engulf this one doji. It's a 3-bar swing for a sell. That was your entry. And then the market maker came up for another stop hunt, which is this bullish candle here, pin hammer. And then I said, oh yeah, I see you, I got you. And entered in for a sell. Any questions on that?
No.
Cool.
Perfect, man. Perfect.
All right. So let's go. I'm going to show you guys how I'm reading levels here really quick. All right. And if you don't get levels right away, no worries. Let it come to you. All right. Okay. So on reading levels, I establish my peak formation high, peak formation low, right? So now that I have my peak formation high and low, what I'm going to do is box it off. So this is peak low, right? And how I'm reading it is I'm marking off breaks in market structure, because then that's the next level. Okay. So if you notice, see this right here, that was a break in structure right there. And the break in structure is right here. Price came here, peak formation low, came up, right? Okay. Price actually came deep down here and then broke this level here again. So where is the level that we're breaking? We broke it here. In fact, let me, I'm going to remove this 50 line because I don't want, this way it's cleaner and you guys can really see it. I'm going to remove this 50 line too. All right. Because right now I just want to show you guys the reading levels. I'm going to remove this and remove this. Boom. Okay. You identify your levels from breaks of market structure, minor structures. In this case, we are reading it here. Let me change this color here so it's more defined. Oh, let me do this line and then make it thicker. Okay, so we have BMS here. Boom. Okay, so we have a weak attempt for another BMS here, but I would not call that a BMS. Price actually came down here. So in reality, this box would actually be covering this here. So there's your level one right there. Boom. Okay. And here's your level two. Because can you see why this is level two? Can you see this? Huh? How is that level two? Because price BMS here. See it?
Okay.
This will make sense once as we go deeper into it. So if you notice, so it's level one, level two. In fact, let me label this. Boom. Level two. Okay, what should we have expected? We should have expected price to come up and give us another level three, right? But no, it didn't give us that. You know, it's just the way it is. So what do we have next? We have a reset. And how I identify a reset is because you see all of the, hold on a moment, let me mark this. Now, how I identify all this as a reset, because you see the squeezing of the moving averages. You see it? The squeezing, all this squeezing, that is a reset. It's sideways range. Okay, I mean, let's go back so this way you can. This will be a lot more clear to you guys. Okay. So take a look at this here. Call this. Oh, this is already peak formation high. But this is so. In fact, let me just do that. Leave that there. Okay. So this peak formation high. So I'm gonna box this off right there. Right. Here's level one. Yep, that's level one. Okay, this will make sense in a moment. I'm going to show you something. All right. Level two. right here, because we BMS this. And then this is level 3. Peak formation high, level 1, level 2, grab this. Okay. Level 3. Once we hit level 3, peak formation low. See that? See how that just happened? Okay. Level 1. All right, let me show you some. Peak formation high will be identified when you see a widening of the moving average and it starts to squeeze. You see this, the 50 and the 200? See it widen? The gap between this is so wide, and it identified a peak formation high here, and then it started to squeeze. That's how I knew this was my peak formation. And once price broke this BMS right here, right? Let me see. Yeah, let me do this BMS. Once price broke that, I knew this was level 1. So now this is level 1, right? For this market day open, I'm going to be looking for pushes up and entries on sells, right? And once I enter it in on a sell, I could look to hold 3 levels deep. That's the purpose behind learning levels, so you know where you are within the what's called the market maker's cycle. They call it the market maker's cycle. But the most important thing is identifying peak formation high. And once you've identified peak formation high, you see the break in market structure, which gives you a level 1, right? Consolidation, break in market structure, level 2, consolidation, break in market structure here to give you a level 3. And what happens is level 1 is identified when there's a crossover between the 50 and the 200. You see it right there? That's your level 1. That's why this is level 1. The beginning of the widening of the 200 and the 50 moving average is level 2. When it gets very wide, it's level 3. And when it gets very, very wide and starts to squeeze, there's your peak formation low or change. And then again, level 1, crossover, right? Right here, crossover. Actually, this was an attempted crossover right here. But it's still, nonetheless, it's level 1 because we broke structure here. We broke structure to the upside, level 1, and then pull back. And it, let me remove this. This is just confusing. But this is a level 2 right here. Okay, so why did we not get a level 3? The reason why I would identify we did not get a level 3 going to the upside is because institutional order flow is bearish. That's why you will see level 1, level 2, level 3 going down, but you won't see it going up. You might, but it's got to be a strong push. But for the most part, this is how I'm reading it. Peak formation low, level 1, level 2, reset. So what happens during a reset is really all consolidation. So during this consolidation period, I'm waiting for a breakout. You know, since institutional order flow is still to the bearish side, I'm waiting for price to actually break this BMS this here, right there. And when price BMS is this, I know from this reset, we will now have a defined level 1. And now I'm counting my levels. Got it, guys? then we should expect price to hit a another level 2. But you know, we're so close to dancing right here at along the major support line, which is this right here, right? That there's a likelihood we could break this on level 2, level 3. And if he does, well, we are going to go to the order block that I've talked to you guys about down here, this order block, right? This one right here, because this is significant. Yeah, this one touched. Did it touch it? No, it didn't touch it, but you know what? This candle filled it. So this is actually the significant order block. So price will actually come down here and just chill right here. And then I'll DCA. I'm actually waiting for this. Yeah. I had a lot of money waiting DCA. I liquidated a lot of gold and long-term bonds that my wife and I have been accumulating. And I'm waiting on the sidelines with all of it, just waiting to move it. Any questions on this, on levels, guys?
I don't have anything.
All right. So that's it. That's how I'm reading the levels. Hey, so you know, we'll let's jump on this really quick and just kind of backtrack and show you what how I'm reading the rest of the levels here. Okay, so here's another peak formation low right here. Okay, so this being peak formation low right there. Oh, it's another one right there. All right, so this is peak formation low. You could also identify a change in level when price breaks the 50. And in this case, see the 50 EMA, broke the 50 EMA, came back and pulled back into it. And then, of course, you see the crossover between the 50 and the 200. That right there is an established level 1, which is right there, right? It's right there. And then, of course, level 2, right there. And then price peak formation high. So again, you see what happened there because of your counter trend. That's a counter trend. Oh shoot! What? Whoa, that was weird. Okay. Oh, all right. There's level 2. Okay, but this is counter trend. So the expectation is we're not going to hit 3 levels. We might, but the expectation is we're not gonna. Okay, so so if we were to go back here, we have another peak formation, right? But this is kind of consolidation. Yeah, yeah. Okay, so right here, peak formation. Level 1. Level 2. And then went into peak formation. So from here, peak formation low, SMS. Oh, you know, this is a good example of what I showed you guys earlier, which is this right here, right? Like, see it? SMS. Do you see the SMS? BMS mitigation, it mitigated this right back to this range. You see it? And then
Yeah.
he took off. Yeah. So if price BMSs, you could expect a price to come back. So when price did BMS this right here, just be patient, wait for price to come back. It'll come back. And when it did, it moved to the upside. Okay. So this is peak formation low. And then we have right here, it really just did a level one level. Yeah. You know, yeah, that's it. So here, level one, and then it gave us peak high, level one, level two, and then peak formation low again, and comes back up, level one, level two, peak formation high. So you guys get that? The
Yeah.
deeper,
So
yep, go ahead.
if I was trying to identify the levels in real time, would I use the EMAs?
Yeah, yeah. You're going to want it. That's one of the reasons why I have EMAs on my chart. I'm identifying levels. Yeah. And I don't, I'm not reading them like actively, but I have an idea of where they are. So what's important to me is that I'm waiting for the 50 crossover, this right here. Because I'm as a trend trader, right? Once this crosses over into the 50, I know he's going to pull back into it. I've explained to you guys before that that's my salt to my cookie. You know, when he pulls back into it, there's my entry. Boom, right? He's going to cross into the 50. See this 50? Let me increase that. Hold on. When he crosses into the 50, I am looking for when he crosses crosses the 50 from a whatever level they're at. I'm expecting for a bounce back into it, mitigation, and then that's my entry, and that's my play right there. But then what happened is, take a look, price range sideways, and again, if we were to drop based on reading our fibs, if we drop our fibs, right, from here to here, here's the 50 line. Last week, I didn't like this here, all this stuff going on, because if I missed a play, first of all, I missed one of the entries, and it is what it is, you know. So if I miss it, I always wait for the next bus. But I don't chase the trade. I don't chase it. I used to chase trades, but you wise up to it. Okay, let me show you something. So we got those 250 lines. Now let me remove the fib, right? Clean it up a little. Let me remove this. And then I'm going to change this. Oh, shoot. All right. That was approximately here. All right. That's the 50 line on the 1 hour fib. This one is the 4 hour. But what I'm going to do is I'm going to change this to a dotted line and make it thin, so I can differentiate based on my eyes. This is a 1 hour. This is the 4 hour fib line, 50 fib line. What I didn't like last week is that you notice this We had 2 days consolidation, and it's dancing on the 51-hour line. Understand that traders get fucked on this. Sideways consolidation is the biggest reason why traders blow accounts. That's why I wait for break above I needed to break above, look for a line of liquidity, and now that I'm 50 or better, I knew that was my entry. That's why I waited. I didn't get in here all last week. It was just a rough week. I missed this here, and then it gave me this, and I was like, oh man, I'm floating on the 1 hour fib. And then at the same time, I got the 50 right over my head. Said, you know what? If price hits around this range here on this liquidity, or even this liquidity, hits above the 50, I know that's my entry. Yeah, so that's how I'm reading it, especially the fact that this is a large reset with the squeezing of the MAs, bouncing in the 50 line, bouncing on the 4 hour 50 line. Hard to read an entry. I don't want to blow an account, so I'm just holding to the sideline and waiting for something to give me a play. Make sense, guys?
Yeah.
Yeah. So that's why. Really, a good trader will actually just wait patiently, like a hunter waiting for that gazelle to go back to that water, that moat, and drink from that body of water. And once he comes back, you take the shot. And that's what I did. Last week, I didn't see it. I missed this, didn't see this. I didn't see it, didn't like it. And I waited for it to get closer to this liquidity. And once it entered into that liquidity, I said, okay, what chart pattern is it going to give me? What's it going to give me? All right. So that's it, guys. Any questions on anything we covered?
No, it's a lot to process right now.
Yeah, it can be. I totally understand, especially introduction of fibs, you know. I'm sorry, not fibs, levels. That's why I don't really like to show levels until someone's got like stuff, you know, knowledge under their belt. You know, because you can, it's easy to accumulate some MUs, and you know, but take this as an opportunity to accumulate more knowledge. Wait for the next Zoom, and we'll keep adding on top of it, and eventually all of this will make sense. But understand this. It is not necessary if you know how to read these levels in order for you to find plays. So as long as you can read market structure, you know where to drop your fib, you know how to read chart pattern, you know how to read a candle pattern. You go from the high time frame to the low time frame, find your entry, you'll always make money. All right, guys? No need to make it complicated. None at all. All that other bullshit, people waiting for, oh, it's going to hit this, it's going to hit that. No, man, just they're going to wait forever in order to find an entry. Where we know how to read market structure, we know how to read 50 institutional 50 range or better. We know how to read chart pattern. We wait for the 1 hour candle. We wait for the chart pattern to reveal itself, and we find an entry. All right, man. Good class. If you guys got any,
I just at the last minute.
yeah.
I put my kids to bed real quick, man. But gosh, man, I'm gonna review the last part that I had to walk out on, man. But gosh, thank you so much, man. You're incredible, dude.
Yeah, absolutely,
Hey,
absolutely. Yep.
hey, Jules, can I ask you one real, just super quick question?
Uh-huh.
Hey, so on the fibs, you um the way you dropped your fibs at the very last minute, mine's is just slightly different. Last time, you know, we talked about, you showed me, you went from where the level two, no, actually, no. Yeah, you dropped your fibs, the top was like where level two was, and then the not that PFL, but the higher, the lower one above it. That's how I thought you had your fibs drop last time. So not that one, the one right above it. This one right.
Oh, up here.
Yeah. So if you drop your fibs from level two, where your level one BMS is.
Yes, right here.
Yes, down to the end, to the bottom of that order block.
Oh, to this order block. Yes. You know what? You can do that. It's really close. So either one would work. Take a look at where the 50 line is on this. You know,
And that's the thing. So right now, so dropping like that, the 50 line price action is below that 50 line. And so like it was kind of, but the way you dropped it earlier, price action was above the 50 line. So it would throw off judgment on when to enter and exit. I mean, it's so close to equilibrium right now anyways, that I just was,
yeah,
I wouldn't even really do much, but if it was a certain percentage below the 50, then, I was thinking about,
yeah,
just where price action would go in general. That's all.
yeah. You know what? In real time, when I'm marking out my fib, my fib is dynamic. So in reality, I would actually put it right here. I placed it here as the example, right?
Oh,
But I would definitely put it right here because we would need. This is major structure. This is the
exactly.
major structure that price needs to break in order for confirmation of continued downtrend. Does that make sense?
Makes perfect sense. Thank you. I just
Okay.
want to confirm that. Thank you.
So you are correct. Yep. And in real time, as price continues to show itself, and these things are dynamic, and you're constantly moving forward to the hard right. You're constantly moving it. So it might have started here, right? But then once and let me show you. Let me remove this. Grab the. Okay, here. It might have started down here, came up here because now price is pulling back here. So this is where we are. So if you notice, it hit the 75 line, but then it came up here, and now it's giving me a new line. So now I have to ask myself, since they gave me a new line, and this is my swing and market structure right here, right? Because that's what it is. What would price have to break in order for me to have a continued bear run? It would have to break this. So my fib setting would actually move from this SMS point, the beginning of the SMS, to this. I would move it like this.
Okay, perfect. That's how I have mine. Thank you so much.
Correct. So dynamically, I'm moving this accordingly. So let me move this here. Boom, there it is. So when I remove the fib line, I have my hard, let me remove this. It's just for, okay, so I have my hard fib line, which is the 4-hour fib right here, 50. And I have also my 1-hour 50 fib line right here. I want price to give me 50% or better, which it did here. I know that bias direction is still for a sell. The daily chart says it. The 4-hour chart says it. We also never came to test this right here. By the way, this peak formation high is now a big deal. This, where the top of our new fib line is. Because keep in mind, if this is our low, right, and we break this, confirmation of continued downtrend. If we break this, this is BMS to this SMS. Do you see that?
Yes.
That's what.
Yes.
That's why
Exactly.
that peak formation high that was produced was that 2 weeks ago. This right here, I like this a lot, a lot. I like this because this defined this the zone flip. This is the top of the zone flip. Again, going back to the zone flip. That's why I really like that, because now I have a point to determine whether or not SMS to a BMS. Okay, I was talking to my wife about this because she was like, she said, Julius, I messaged you, Justin. I said, hey, I got to just talk to my wife really quick because I'm asking her to get into door, right? And she's like, yeah, but Michael Burry saying the market's going to crash and it's that. And I had to explain to her, look, we're at a zone flip. We're DCAing. Don't worry. I know what I'm
Oh.
doing. So
Oh, so
what
you're
I
getting into door?
yes, yeah. Well, I not yet. I didn't get into it. She said let's wait till tomorrow, and she wanted me to talk to you, Justin, to find out your thoughts on it before I got into it.
Okay. Yeah. Yeah. Absolutely. Yeah. I'm gonna do a lot more research. Well, I don't want to add anything to this Zoom, so I'll keep it separate.
Okay, so the significance of this high, this peak formation high, is because it gave me a point to determine where a BMS would have to happen. Because this is what I told her, Emily, I don't know whether or not price is going to go down below 29. I said, I don't know. But what I can tell you is that I see price forming, right? And I could see if we, an area where if we BMS and we have this SMS here, right? That right there, SMS, and then we would need price to BMS this potential BMS. If price BMS is this, that point, it validates this SMS. And guess what we have? We have a bearish trend. We have a change in trend. That's why anyone that's saying, and again, in the past, I've explained, I don't have a crystal ball. Anyone that says we're definitely going down to the 20s is BS because they don't have a crystal ball. How are they determining this? I would love to know. I can tell you where the order block is, right? I can tell you it's here. So, but we need to BMS first. If we BMS, I know how deep we're going. You see what I'm getting at? If we BMS, I know we're going up. If we BMS this, I know how deep we're going. But to tell you that we're going to definitely get down into the 20s, that's a lot of BS right there, man. That is. All I could tell you is where the liquidity is flowing currently. And anytime price hits 50 line or better, I trust that we are going to be moving to the downside, which we did see it yesterday, right? So that's why I went in on the entry. However, that being said, I love the fact that this 36 was created here on a peak formation high because this gives me the potential BMS. And if price breaks that, we now have a confirmed SMS to BMS. Now, remember that example I showed you on price mitigation. If price BMS is this, what do we expect price to do?
Pull back to it.
That's right. Boom. We got no crystal ball, but we know how to read liquidity. We know how to read the market. He's going to pull back to that. So don't get scared if he jumps up to 40,000 when he BMSs. Wait for the pullback. Wait. Everyone's going to get in on the 40 and they're going to, oh, fuck, I missed it. Nope, he's going to drop back to the 36 because this is the flow of how the market works. Because you got to remember, the guy that came in here that produced this peak formation high, that guy spent 50 million with his buddies to push the market down. He's in it for a sell. If price goes to 38, he's going to call his same buddies and say, hey, drop 50 million so we can mitigate. They're going to bring it back down to this BMS. So don't worry about, in fact, that's my play. I love that. Remember, the charts are fractal. If I see a BMS on a 1 hour chart, I don't jump in prematurely, blow my load. I wait for the pullback because that's my play, because I know it happens all the time. You have to trust that what's happening behind the scenes. That guy that has a sell is now bleeding. He will force the action down in order to mitigate, ease a losing play. He will do it himself, and he'll call a couple of his buddies to do it. All right, guys? Hope you caught that.
All right. Thank you.
Cool, man.
Thank
All right.
you so much, dude. Appreciate it, man.
Yeah, you bet. So that's it. End of class. Till next time, right, guys?
Have a good night.
Man, have a good night.
All right, guys. Talk to you.